When the history of modern banking is told, it usually begins in safe, familiar places. Florence, where merchant families refine bookkeeping. Amsterdam, where joint stock companies reshape trade. London, where central banking supposedly emerged as a natural response to industrial growth. These stories are repeated so often they feel settled, unquestionable, almost inevitable. Banking, we are told, evolved the way technology evolves, step by step, improvement by improvement, driven by necessity and innovation. But that version of history depends on one assumption that rarely gets examined. It assumes there was nothing before it, because buried beneath the official timeline is a problem historians rarely confront. When modern banking appears in the record, it does not appear in a primitive or experimental form. It appears already mature, already complex, already global. The institutions arrive with vaults, protocols, communication systems, architectural uniformity, and legal authority that should have taken centuries to develop. And yet, we are asked to believe they emerged fully formed within a single generation. That contradiction is where the real story begins. In 1743, in Frankfurt am Main, a boy named Meyer Amschel Rothschild was born into the Jewish ghetto. According to the official narrative, he rose from obscurity through brilliance and discipline, transforming himself from a coin dealer into the patriarch of the most powerful banking dynasty Europe had ever known. By the time of his death in 1812, his sons controlled financial houses in Frankfurt, London, Paris, Vienna, and Naples. Within one lifetime, a family with no documented financial legacy supposedly constructed the largest private banking network in the world. It is an extraordinary story, too extraordinary, because when the early records are examined closely, the foundation of that empire looks less like construction and more like occupation. The Rothschilds did not slowly assemble infrastructure. They did not spend decades building vaults, establishing trust networks, or inventing transfer mechanisms. They stepped into a system that was already operating, a system that should not have existed, according to the accepted timeline. Private correspondence, architectural anomalies, and suppressed archival material all point to the same conclusion. Long before the Rothschild name became synonymous with finance, a transcontinental banking network already spanned the Old World. It reached from Iberia to Central Asia, from Mediterranean ports to inland trade cities that officially lacked the sophistication to support such operations. Its records predate the so-called invention of modern banking by centuries, and once it was taken over, its existence was erased. This system is referred to in surviving documents by different names, but in the fragments that remain, one term appears again and again: Tartarian. Not the Tartary of school textbooks, dismissed as a vague medieval label for unknown lands, but a structured, organized civilization with standardized architecture, shared symbols, and a unified economic framework. The Tartarian banking network did not resemble modern finance in name, but in function it exceeded it. The first clues are not found in documents at all. They are found in stone. Across Europe and Asia, certain buildings share a strange consistency. Structures now labeled as banks, courthouses, treasuries, and government offices display repeating design elements regardless of country or era. Massive stone facades adorned with symbolic reliefs, columns built to proportions that repeat across continents, domes engineered with a precision that should not have been achievable in the periods they are officially dated to. Interior layouts that mirror one another despite having no acknowledged architectural lineage. Most telling of all are the vaults. Beneath these buildings are subterranean chambers that extend far deeper than their supposed construction dates would justify. Vaults built of stonework inconsistent with 18th or 19th century engineering. Vault whose dimensions suggest they were designed to store vast quantities of physical commodities, not paper instruments. Vaults that interconnect beneath city centers, forming underground networks that predate the streets above them. In many cases, these buildings are claimed by local histories to have been constructed in the 1800s, and yet they appear unmistakably in paintings, city plans, and traveler accounts from centuries earlier. The dates do not align. The explanation is usually waved away as renovation, coincidence, or artistic license. But when the same anomalies repeat across dozens of cities, coincidence stops being convincing. The Rothschild banking houses occupy many of these buildings. In Frankfurt, the family's early properties sit atop deep underground chambers extending beyond their legal boundaries. In London, Rothschild-connected banks are linked by tunnels beneath the financial district. In Paris, subterranean passages connect institutions that are officially unrelated. In Vienna and Naples, similar patterns emerge. The claim that these buildings were commissioned and constructed by the Rothschilds collapses under architectural scrutiny. They did not design them. They inherited them. Or more precisely, they took possession of them. According to documents recovered from sealed archives in the Ural Mountains, the Tartarian banking system operated through what were known as value houses. These were not banks in the modern sense, but they performed equivalent functions with crucial differences. Each value house operated independently, bound to others through strict protocols rather than centralized authority. They issued standardized certificates backed by physical commodities, gold, silver, grain, and other tangible goods stored in the vaults beneath them. Value could be transferred across enormous distances through this network in a matter of days, despite the absence of telegraphs, railways, or modern communication. Verification protocols ensured trust without requiring personal familiarity. Disputes were resolved through established arbitration procedures that left written records still partially intact today. And perhaps most striking of all, the system charged no interest. The Tartarian documents describe interest as a destabilizing force, not for moral reasons alone, but mathematical ones. They understood compound interest. They understood that any system allowing wealth to grow exponentially without corresponding creation would inevitably concentrate all value in the hands of lenders. Their system was designed to prevent that outcome. Instead of interest, value houses charged capped fees, storage fees for physical commodities, transaction fees for transfers, service fees for verification and authentication. These fees could not compound. They were proportional to actual labor and infrastructure costs. The system functioned not to extract wealth, but to facilitate exchange. This is the system the Rothschilds encountered. Meyer Amschel Rothschild is officially described as a dealer in rare coins and antiquities. That description is accurate, but incomplete. Coin dealing in the 18th century was not merely a hobbyist trade. It was a gateway into older systems of value. Rare coins often came with provenance. Provenance led to archives. Archives led to knowledge that was not publicly available. Private correspondence that briefly surfaced during a 1923 auction suggests Rothschild became aware of the old banking network through such channels. One letter, allegedly written to his son Nathan, described the system not as a relic, but as a dormant infrastructure awaiting control. The letter emphasized that the houses still stood, the vaults remained sealed, and the original operators were no longer in a position to defend them. What was required, the letter stated, was not construction, but occupation. The letter vanished into a private collection and has never resurfaced. But what followed aligns precisely with its contents. Between the 1760s and the early 1800s, the Rothschild family expanded at a speed that defies conventional explanation. Within a single generation, they established major banking houses in 5 capitals simultaneously. Each house was run by one of Mayer's sons. Each house immediately operated at a scale and sophistication that would normally require decades of development. They did not compete with one another. They coordinated. Information flowed between them faster than governments could manage. Capital moved across borders with uncanny efficiency. Political events were anticipated, not reacted to. Kings and ministers found themselves negotiating not with isolated bankers, but with a unified financial front that spanned Europe. This was not entrepreneurship, it was succession. The original operators of the Tartarian system were referred to in surviving records as the keepers. They were described as a hereditary class, trained from birth in the management of value. Their neutrality was absolute. They served all sides in conflicts without financing the conflicts themselves. They preserved their knowledge through bloodlines that stretched back centuries. And then, within a single generation, they vanished. Between 1760 and 1815, references to the keepers disappear from the record. Not gradually, not through assimilation, abruptly. Their properties changed hands. Their protocols were replaced. Their symbols were adopted by others. Their names were removed from public memory. This disappearance coincides exactly with the rise of the Rothschild network. No official document records the displacement, but the consequences are everywhere. The system that had prohibited interest was replaced by one built entirely upon it. The decentralized network was replaced by a centralized family hierarchy. A financial framework designed to serve commerce was replaced by one designed to control governments. By the time Europe emerged from the Napoleonic Wars, the transformation was complete. The old system was gone. Its infrastructure remained, occupied by new masters. Its history had been erased, and a new narrative was written, one in which modern banking appeared not as a takeover, but as an invention. And this is only the beginning. To understand why the Tartarian banking system had to be replaced, not reformed, it's necessary to understand how radically different it was from anything that followed. Not just in structure, but in philosophy. The system was not built around growth for its own sake. It was built around balance. Each value house functioned as a node rather than a headquarters. No house commanded another. Authority flowed through protocol, not hierarchy. Every transaction followed standardized rules that were older than the states that later tried to regulate them. These rules governed verification, storage, transfer, and accountability. A value house in Iberia could accept a certificate issued in Central Asia because both operated under the same framework, enforced not by armies or kings, but by exclusion. Any house that violated protocol was cut off from the network. Without access, it ceased to function. This was the enforcement mechanism: silent, absolute, effective. The system relied on physical reality. Certificates represented tangible goods stored in known vaults. Gold was weighed, assayed, cataloged. Grain was measured, inspected, preserved. Silver was sealed and stamped. Nothing circulated without physical backing. Nothing could be created by declaration. Value could only move, not multiply. This constraint is what made the system stable. The documents recovered from the Ural region describe a communication method that modern historians struggle to explain. Couriers moved along established routes with extraordinary efficiency, protected not by military force, but by the system's neutrality. A courier carrying value house documents was considered untouchable. To interfere was to place one's entire city outside the network. No ruler could afford that. Information traveled faster than armies, faster than merchants, sometimes faster than official state messengers. This is how value could be transferred across thousands of miles in days rather than months. Not by magic, but by discipline, redundancy, and trust maintained through generations. Contrast this with what replaced it. The Rothschild system inverted the logic. Where Tartarian banking decentralized authority, the new system concentrated it. Where value was previously tied to physical goods, it became increasingly abstract. Where neutrality had been enforced, alignment with power became profitable. Interest was the key insertion point. The Tartarian documents are unambiguous about interest. They do not debate it, they warn against it. Interest is described as value extraction without production. Compound interest in particular is described as mathematically fatal to any system that allows it to persist unchecked. The documents demonstrate an understanding of exponential growth centuries before such concepts entered mainstream mathematics. They understood that if debts grow faster than economies, ownership inevitably transfers to lenders. They understood that governments borrowing at interest eventually lose sovereignty. They understood that populations paying perpetual interest become permanent labor pools for unseen creditors. This was not philosophy, it was arithmetic. When the Rothschild network assumed control, interest was not introduced cautiously. It was imposed aggressively. Loans to governments were no longer transactional accommodations. They became instruments of control. Interest compounded. Debts rolled forward. Refinancing replaced repayment. States became dependent not just on capital, but on permission. The speed of this transition is critical. Within a single generation, European governments that had operated without permanent national debt found themselves unable to function without continuous borrowing. Military expenditures, infrastructure projects, even basic administration became impossible without bank financing. And the banks were no longer neutral facilitators. They were private entities with coordinated interests. The Napoleonic Wars provided the perfect cover. Between 1803 and 1815, Europe burned. Armies marched, borders shifted, crowns fell. Governments needed unprecedented amounts of capital to fund destruction on a scale never seen before. The Rothschild network supplied it. But unlike the old system, which forbade financing war, the new system embraced it. Both sides were financed. This is not speculation. It is documented. Loans flowed to opposing coalitions. Currency exchange operations profited from volatility. Gold shipments moved quietly beneath the chaos. When the wars ended, it did not matter who won militarily. The debts remained. The interest accrued. Sovereignty had already changed hands. By 1815, after Waterloo, the Rothschilds were no longer merely bankers. They were power brokers. Governments negotiated with them as equals, sometimes as superiors. Policies were shaped around repayment schedules. National budgets prioritized debt service over public welfare. This was not accidental, it was structural. And beneath the surface, the old system vanished completely. The keepers did not fade into obscurity, they were removed. Their archives were seized or destroyed. Their buildings were occupied. Their symbols were repurposed. Their protocols were overwritten with new procedures that served different goals. One of the most revealing remnants of this transition lies underground. Modern explanations for subterranean banking infrastructure are insufficient. Banks require vaults, yes, but the scale and connectivity of the vaults beneath Rothschild-associated buildings exceed any reasonable security requirement. These are not simple storage rooms. They are engineered complexes. Multi-level chambers, reinforced corridors, interconnected passages extending beyond property lines. In London, these tunnels link institutions that officially have no relationship. In Paris, they run beneath streets laid centuries after the tunnels themselves were constructed. In Frankfurt, the stonework beneath early Rothschild properties matches techniques abandoned long before the 18th century. The explanation that these were built hastily during the 19th century for gold transport does not hold. The engineering is too precise, the stonework too old, the layouts too intentional. These were not additions, they were inheritances. When the Rothschilds assumed control, they did not need to build vaults to store gold. The vaults already existed, and they were already full. This brings us to the gold discrepancy. By the early 19th century, Rothschild vaults contained quantities of gold and silver that cannot be explained by known commercial activities. Even accounting for profits from war financing, currency exchange, and bond trading, the numbers do not reconcile. The reserves appeared too quickly, too completely. Nathan Rothschild's actions after Waterloo are often cited as the turning point. His early access to news, his aggressive buying while others sold, his exploitation of panic. These actions certainly multiplied his wealth. But even this legendary maneuver does not account for the scale of reserves that appeared shortly thereafter. The missing source is the Tartarian vaults. When the old system was displaced, its physical backing did not vanish. It was absorbed. Gold stored for centuries beneath value houses did not evaporate. It changed ownership, claimed without transaction, absorbed into a new accounting framework that recorded it as family capital rather than public trust. This explains several anomalies: why early Rothschild genealogical records are thin before Meyer-Amschel, why initial capital sources are vague, why architectural timelines conflict with official narratives, why the family's rise appears sudden, complete, and irreversible. They did not accumulate, they inherited by seizure. And once the takeover was complete, the rules changed permanently. Central banks emerged not as public institutions, but as private mechanisms cloaked in national symbolism. Currency creation became separated from physical reality. Money was no longer a representation of stored goods. It became a representation of debt. Governments borrowed currency into existence, paying interest on money that did not previously exist. This inversion is critical. Under the Tartarian system, value preceded currency. Under the new system, currency preceded value. Production became secondary, control over issuance became everything. Within a century, this architecture had spread globally. Central banks appeared in nation after nation, all operating on the same principles. Private ownership hidden behind public mandates, interest-bearing loans to governments, permanent national debt, monetary policy dictated by unelected authorities. Every element of this system directly contradicts the principles outlined in the Tartarian documents. The documents warn that once value creation was centralized, political power would become illusory. Governments would exist to administer debt. Populations would labor to service interest. Wars would become profitable. Crises would be engineered. Wealth would concentrate until instability became unavoidable. Looking around the modern world, it is difficult to argue that this warning was wrong. And yet this is still not the deepest layer, because the symbols did not disappear, they were reused. The red shield, the 5 arrows, the pentarchical structure, the closed bloodlines, the emphasis on heredity. These were not inventions of the Rothschild family. They were inheritances from the system they replaced. Symbols of authority repurposed to legitimize new masters. Which raises the most unsettling possibility of all, that the Rothschilds were not the architects of this transformation, that they were the visible face of it, that behind the takeover, behind the displacement, behind the rewriting of history, there existed forces that did not want to be named, recorded, or remembered. Forces that understood that the most durable empires are not built with armies, but with ledgers. And that understanding is what carried the system forward into the modern age. Once symbols are examined, instead of dismissed, patterns begin to surface that cannot be explained away by coincidence. The red shield is the most obvious example. Officially, the Rothschild name is said to come from the red sign that once hung outside a house in the Frankfurt ghetto. A convenient origin story, memorable, harmless, almost folkloric. But the same red shield appears carved into stone on buildings across Europe and Central Asia that predate the Frankfurt ghetto by centuries. The proportions are identical. The placement is consistent. Above entrances, near vault access points, integrated into architectural reliefs that mark institutional rather than residential use. In Tartarian architectural studies, the red shield is not identified as a family name. It is identified as a designation, a marker used by value houses to signal legitimacy within the network, a sign that the building adhered to shared protocols, a visible assurance of trust. The Rothschilds did not originate this symbol. They inherited it, or were granted the right to use it. The same is true of the 5 arrows. The Rothschild family crest depicts a clenched fist holding 5 arrows. The official explanation is that the arrows represent Meyer Amschel's 5 sons, unified in purpose. It is a neat metaphor, but the symbol itself is far older than the family. It appears in Tartarian documents as the emblem of the pentarchy, a governing structure composed of 5 autonomous regions, each maintaining its own value houses while coordinating with the others through shared rules. 5 centers, 5 authorities, no single point of dominance. Balance through distributed power. When the Rothschild network expanded, it replicated this structure exactly. 5 cities, 5 brothers, 5 houses operating independently but acting in concert. Frankfurt, London, Paris, Vienna, Naples. The alignment is too precise to dismiss. This was not an invention, it was a copy. And the copy did not preserve the intent. Where the pentarchy existed to prevent concentration, the Rothschild adaptation used the structure to disguise it. The appearance of decentralization masked unified control. Governments negotiated with individual houses, unaware that all answers came from the same ledger. This illusion of separation was critical to the system's survival. The marriage patterns reinforced this conclusion. For over 2 centuries, the Rothschild family maintained unusually strict marriage practices. Cousins married cousins. Uncles married nieces. Bloodlines were folded inward, generation after generation. The public explanation is that this preserved wealth and trust in a hostile world. But wealth alone does not require such rigidity. Many wealthy families diversified bloodlines without losing control. The Tartarian documents describe similar practices among the keepers: closed lineages, limited external marriage. The belief that the capacity to manage value, to maintain trust across distance, to operate the protocols of the system was hereditary, something cultivated over generations, something that degraded if diluted. Whether this belief was correct is beside the point. What matters is that the Rothschilds adopted the same behavior, not sporadically, systematically, as if following inherited rules rather than personal preference. Which raises an uncomfortable question. Were the Rothschilds initiators or were they inductees? The resilience of the family suggests protection beyond wealth. Revolutions have destroyed aristocracies, empires have collapsed, royal bloodlines have been erased. But the Rothschild network endured every upheaval intact. Governments fell, borders redrew, currencies collapsed. The family adapted without loss of influence. That level of continuity does not occur by chance. The 19th and 20th centuries provide further evidence. Leaders who attempted to dismantle or bypass the banking system faced remarkably consistent outcomes. Andrew Jackson dissolved the Second Bank of the United States and survived an assassination attempt. Abraham Lincoln issued greenbacks, bypassing private bank lending, and was assassinated. James Garfield criticized banking monopolies and was assassinated. William McKinley resisted banking consolidation and was assassinated. John F. Kennedy issued silver certificates, challenging Federal Reserve dominance, and was assassinated. These are not obscure figures. These are central nodes in modern history. The pattern does not prove causation on its own, but patterns do not need proof to be alarming. They need only repetition, and repetition is undeniable. The Tartarian documents describe similar enforcement mechanisms in earlier eras. Any ruler who threatened the integrity of the value network would be removed, not publicly, not immediately, but inevitably. The system protected itself. Kings were temporary, the ledger was eternal. This philosophy survived the takeover. Wars became not disruptions to finance, but tools of it. Every major conflict since the early 19th century was financed by interconnected banking interests. Loans issued to all sides. Reconstruction financed after devastation. Reparations structured to ensure long-term dependency. Destruction followed by debt, followed by reconstruction, followed by more debt. It was a closed loop. Under the Tartarian system, war financing was explicitly prohibited. The documents are clear. Value exists to facilitate creation, not destruction. Any house that financed war would be expelled. Neutrality was absolute. Commerce continued. Conflict starved. Under the new system, war became the most profitable enterprise imaginable. This inversion explains the unprecedented scale of modern conflict. The Napoleonic Wars were only the beginning. Industrialized warfare, global conflicts, total mobilization. Each escalation required massive capital outlays. Each outlay generated interest-bearing debt. Each debt transferred sovereignty incrementally from nations to lenders. By the 20th century, the transformation was complete. Gold-backed currency, once a constraint, became a weapon. By controlling gold reserves, banking families controlled currency values. Economies could be inflated or strangled by adjusting supply. Nations that cooperated found credit abundant. Nations that resisted found reserves drained. Currencies destabilized. Markets attacked. The Tartarian system distributed gold across hundreds of independent vaults to prevent this. The Rothschild system concentrated it. Control replaced balance. When even gold became too limiting, the final barrier was removed. Fiat currency. The abandonment of the gold standard did not represent progress. It represented liberation for the lenders. Currency no longer required physical backing. It could be created by declaration, lent at interest, repaid with real labor, resources, and land. The Tartarian documents warned explicitly about this scenario. They described it as the final extraction. When value is no longer anchored to reality, those who control issuance will eventually claim everything that is real. This is not metaphor. It is accounting. The transition to fiat accelerated debt beyond any possibility of repayment. Government obligations grew exponentially. Entire populations were bound to perpetual service of interest. Wealth concentration surpassed anything seen in recorded history. And now the final phase is underway. Digital currency. Central bank digital ledgers. Money that exists only as data. Fully traceable. Fully programmable. Capable of being frozen, altered, expired. Value that no longer even pretends to belong to the holder. Every step in this progression moves further away from the principles of the Tartarian system. Physical backing replaced by abstraction. Anonymity replaced by surveillance. Decentralization replaced by total control. What began as occupation has become domination. The question that remains is not whether the old system existed. Too many fragments align. Too many anomalies resolve themselves once its existence is acknowledged. The real question is why its memory was buried so thoroughly. Because if such a system existed once, it proves that modern banking is not inevitable. That interest-based extraction is not natural. That centralized financial power is a design choice, not an economic law. The Tartarian system worked. It facilitated trade across continents. It maintained stability for centuries. It failed only because it was destroyed, not because it collapsed. That fact alone threatens everything built since. This is why the evidence is dismissed as conspiracy, why architectural inconsistencies are ignored, why archival fragments vanish, why alternative economic models are never taught. The past must remain simple because complexity invites comparison, and comparison invites questions. The buildings still stand, the vaults still exist, the ledgers still extract. The same mechanisms continue to operate, centuries later, enriched by technology but unchanged in intent. Some empires conquer with armies, others conquer with ledgers. The Tartarian system represented a world where finance served humanity. The system that replaced it serves itself. And understanding that difference is the first step toward imagining something else. As the 20th century advanced, the machinery put in place during the 19th did not weaken. It refined itself. What had once required secrecy and intermediaries began to operate openly, normalized as policy. Central banks were no longer curiosities or temporary instruments of crisis. They became permanent fixtures, presented as neutral guardians of stability while operating through mechanisms that guaranteed instability for everyone except those who controlled issuance. The language changed. Extraction was no longer called extraction. It was called monetary policy. Inflation was reframed as growth. Debt was reframed as stimulus. The same process continued, but wrapped in technical terminology that distanced cause from consequence. By the time the public understood what was happening, the structure was already irreversible. Entire generations were born into debt that predated them. Nations ceased to measure success by production or self-sufficiency, and instead measured it by credit ratings assigned by institutions they did not control. Elections changed faces but not policy. Ideologies rotated, but debt remained. The ledger endured while governments cycled through it. This persistence reveals the true nature of power. Political authority is episodic. Financial authority is continuous. The Tartarian system understood this, which is why it enforced strict separation between value management and political ambition. The keepers were prohibited from governance. They were custodians, not rulers. Their power existed precisely because it did not seek dominance. It functioned like infrastructure, unnoticed, indispensable, restrained by design. The Rothschild-era system erased that restraint. Finance became sovereign. The 20th century also produced a new kind of erasure, not just of documents, but of memory itself. Economic education was standardized. Alternative models were removed from curricula. History was simplified into a linear progression that framed modern finance as the inevitable endpoint of human organization. Any suggestion of a different past was dismissed before examination. The Tartarian system became impossible, not because evidence vanished, but because the conceptual space to understand it was removed. When fragments did surface, they were isolated. A vault here, a document there, a building that did not fit its plaque. Each anomaly, examined alone, could be dismissed. Together they formed a coherent picture. But coherence requires permission, and permission was never granted. The Soviet era provided an additional layer of suppression. The Ural Mountain archives, partially accessible in the early 20th century, were sealed during Stalin's purges. What survived was fragmented, mislabeled, or destroyed. Monastery libraries were emptied, private collections confiscated. The state did not distinguish between political threats and historical ones. Both were eliminated. Ironically, this destruction preserved the fragments that remain. What was hidden survived because it was overlooked. What was centralized was erased because it was visible. In the West, suppression was quieter. Documents disappeared into private collections. Auctions were anonymized. Researchers were discredited rather than imprisoned. Architectural studies were labeled fringe. Funding dried up. Careers stalled. Silence proved more efficient than force. By the late 20th century, the system had reached a level of abstraction that would have been incomprehensible to the keepers. Currency floated free of physical reference. Trillions were created with keystrokes. Markets reacted not to material conditions, but to statements, projections, expectations. Value no longer described reality, it dictated it. And yet instability increased. Crises became cyclical. Booms followed busts with increasing speed. Each collapse was met with greater intervention. Each intervention increased central control. Each increase in control required justification, and each justification leaned on fear. Fear of collapse, fear of scarcity, fear of chaos. This is the paradox of the modern system. It claims to prevent collapse while requiring it to justify itself. The Tartarian documents warned of this dynamic explicitly. They described systems that rely on perpetual intervention as already broken. Stability, they argued, must be structural, not enforced. Any system requiring constant correction has already lost balance. The introduction of digital money marks the final structural shift. Central bank digital currencies represent not merely a technological upgrade, but a philosophical one. Money ceases to be something held. It becomes something accessed. Ownership becomes conditional. Permission replaces possession. Every transaction becomes visible. Every account becomes controllable. Every individual becomes legible to the ledger. This is not speculation. It is policy. The ability to freeze accounts, restrict purchases, impose expiration dates on currency, these are not hypothetical features. They are listed capabilities. From the perspective of the Tartarian system, this represents total inversion. The old system preserved anonymity because anonymity preserved balance. The new system eliminates anonymity because control requires visibility. What was once impossible is now trivial. What once required armies now requires software updates. And yet, even at this stage, resistance persists, not in the form of revolution, but in memory, in questions, in the recognition that something is fundamentally misaligned. People sense that endless debt is not natural, that working harder should not result in less security, that prosperity should not concentrate upward regardless of effort below. These intuitions are not accidents. They are echoes of a system that once aligned value with creation rather than extraction, a system that treated finance as infrastructure rather than authority, a system that proved alternatives were possible, not theoretical. The question of whether the Tartarian system can be rebuilt is not a technical one. The mechanisms are known: commodity backing, decentralized custody, capped fees, protocol-based trust. None of these are beyond modern capability. The barrier is not feasibility, it is permission. Because any system that removes compound interest, decentralizes issuance, and limits accumulation threatens the existing order at its root. It threatens not individual institutions, but the logic that binds them together. This is why reform always stops short. Why criticism is allowed, but alternatives are not implemented. Why conversations are permitted, but structures remain unchanged. The ledger protects itself. The Tartarian system failed only once, when it was attacked. It did not collapse under its own weight. It was dismantled deliberately, replaced by a system optimized for accumulation rather than stability. Knowing this reframes history. Economic crises are not accidents. They are pressure releases. Inequality is not a side effect. It is an outcome. Debt is not a temporary measure. It is the mechanism. And the continuity of that mechanism across centuries suggests intention. The Rothschild name endures not because it controls everything directly, but because it symbolizes continuity. A lineage that spans the transition, a visible thread that connects the old world to the new while obscuring what came before it. Behind names, families, institutions, and policies lies the same logic, unchanged. Control the ledger, and everything else follows. The Tartarian system understood this and designed against it. The system that replaced it understood this and designed for it. That is the difference. The buildings still stand because stone remembers what paper forgets. The vaults still exist because infrastructure outlasts ideology. The symbols persist because power never abandons what works. And somewhere, scattered across sealed archives, forgotten collections, and buried chambers, the evidence remains, not as a single document, but as a pattern that tells a different story of finance, one that does not begin with innovation, but with replacement. Not with progress, but with inversion. Not with necessity, but with conquest. Some empires conquer with armies, others conquer with ledgers. The Tartarian banking system was conquered. The system that replaced it conquered the world. And the question now is not whether this history is comfortable, but whether it is true enough to matter. Because if it is, then the future is not constrained by inevitability. It is constrained only by what we are willing to remember and what we are willing to rebuild once we do. What remains after the documents are sealed, the names are debated, and the theories are dismissed is not certainty, but pattern. And patterns are harder to erase than facts. Facts can be burned, edited, reclassified. Patterns survive in stone, in infrastructure, in repetition across centuries. The world we live in does not behave like a system designed for human stability. It behaves like a system designed for control through dependency. Debt expands regardless of productivity. Crises arrive on schedule. Wealth concentrates upward no matter which ideology is in power. These are not anomalies. They are signatures. Once you recognize the signature, history stops looking accidental. The disappearance of the Tartarian system, whatever name one gives it, marks a turning point not because it was perfect, but because it was incompatible with what followed. It represented a model where value was anchored, where finance served civilization instead of ruling it. That model did not evolve into the modern world. It was replaced by it. Replacement always requires erasure. When an old system is truly obsolete, it fades naturally. When it is dangerous to power, it must be forgotten. Its language must be removed. Its mechanisms reframed as primitive. Its evidence scattered so no single piece can stand alone. And yet, the pieces remain. They remain in architecture that does not match its official timeline, in vaults beneath cities that no longer remember why they exist, in financial principles that modern economics quietly avoids explaining, in the shared intuition that something about money, work, and reward feels fundamentally wrong. That intuition is not ignorance. It is recognition without context. The greatest success of the modern financial system is not its scale, but its invisibility. Most people never question why money is created as debt, why interest compounds infinitely while resources do not, why entire nations must borrow what they are capable of producing. These ideas are treated as natural law when they are historical decisions, and decisions can be reversed. The past does not demand belief. It demands examination. You do not need to accept every claim to understand that the official story is incomplete. You only need to acknowledge that alternative systems once existed and that their removal shaped everything that followed. If history is a record of choices, then forgetting is also a choice. The Tartarian system was not lost to time. It was removed from memory, and memory, unlike stone, can be restored. What happens next depends on whether we continue to treat finance as destiny or recognize it as design, whether we accept permanent dependency as inevitable or question who benefits from it, whether we allow the ledger to define humanity or insist that humanity defines the ledger. This channel exists for one reason: to ask the questions that were never meant to be asked and to follow the patterns wherever they lead. If this story challenged what you thought you knew, share it, not to convince, but to invite examination. Subscribe if you want more deep dives into the histories that sit just outside the official frame. Leave your thoughts in the comments, especially if you notice connections, contradictions, or evidence we didn't cover here. The past is not gone. It is buried, and buried things have a way of resurfacing. Welcome to Ages Past.